Hello, everyone. Welcome to Money Hour Radio, a show where we try to help you grow your money, pay less taxes, have a beautiful retirement. I am one of your co-hosts, Ben Barzideh. As usual, I have with me my esteemed co-host, Matt Nadeau.
Hey, everybody.
We are both founding partners and wealth managers at Barzideh and Nadeau Wealth Management, a comprehensive financial planning firm located right here in Barrington. And we are fiduciaries, and as an independent, family-owned firm, we truly have the freedom to focus solely on your interests, not some corporations or those shady private equity companies that are buying everything up these days.
Yeah, and of course, we always want to just take a moment, say hi to all of our clients. We know you listen. You tell us you listen. We appreciate that you listen. And of course, what we really appreciate most is the trust that you've placed in us. And so we want to tell you we love every one of you. And we have a great show. As we always say, we have some interesting topics. Something just blew our mind, something new this week we weren't even expecting. Something big's going on with the bond market and yields. And there was this big announcement we were not expecting that came out on Wednesday by the Treasury. We're going to talk about it. And then later in the show, we're going to talk about a little known fact that people don't really know much about when it comes to their 401ks and employment retirement accounts. And it's called net unrealized appreciation, NUA. And it can be an amazing tax break for certain people who have a lot of money in their company stock.
It's such a good break, especially if they have a lot of appreciation. So you don't want to miss that. As usual, before we start, we encourage you to like and subscribe to our YouTube channel on moneyhourradio.com. It's completely free. That way you can get this episode as soon as it comes out. And if you miss it on the radio, you can see the previous ones as well. And also, we encourage you to sign up for our weekly economic newsletter. It's called the 5-Minute Market Brief. It's totally free to subscribe. It's informative, succinct, and you get a really good idea of what we're thinking and what we're seeing. You can get that on bnwealth.com. All right, Matt, what's going on with bonds? It was kind of a crazy week.
Yeah, that's the question. What's going on with the bond market? What's going on with yields? What's this big announcement? So, the big headlines this week all revolved around inflation and rising bond yields as the interest rate on 30-year treasuries reached this extreme high of 5.33%. That's the highest it's been since 2007, right before, obviously, the 2008 global financial crash. So increasingly higher yields on government bonds have actually been a worldwide phenomenon, not just here in the US. So just as a reminder, now higher interest rates typically end up hurting the economy. And why is because it makes borrowing costs more expensive. And also it'll pressure the stock market valuations. And so really the question is what's going on? And there are actually multiple factors causing the rise in yields. And the two biggest ones, pretty common: rising inflation from high oil prices due to the war in the Middle East. And then there's deteriorating financial conditions in the US and many other countries around the globe.
Case in point, you want to talk about fiscal conditions that are deteriorating. Well, we hit a big milestone this week in the US, and it wasn't a good one. Our national debt just reached $40 trillion. What a mess. That's like when you set the record in a football game, but not for good things, like the most penalties or the most interceptions. And it's not just governments overborrowing right now. The normally fiscally responsible private sector is not borrowing massive amounts of money and spending free cash flow to fund the AI capital expenditure boom, resulting in a massive increase in corporate debt. And as we learned in economics class, the more supply of government and corporate debt into a fixed amount of demand, guess what? The higher the interest rates go. So it shouldn't be a surprise that yields are so high right now.
I mean, Ben, weren't we just listening to an expert saying when we're rounding up to the nearest trillion on a debt, that's not a good thing?
No, that's so messed up. Yeah, because people didn't know. Are we at 38, 39? Like, just roll it up to 40 trillion. And we're just 40 this week. Yeah.
So not good. And here's the other thing. We've been talking a lot this year about the artificial intelligence capital expenditure, CapEx, and ultimately that's good for the economy. And that can ultimately reduce inflation. But right now, what it's doing in reality is boosting prices. And that's pushing inflation metrics higher. And right now, we're not seeing any end in sight. So it's gotten bad enough that Uncle Sam had to intervene. So on Wednesday, the US Treasury stepped up and they gave a little warm, fuzzy sprinkles to the market. And it had this surprise announcement that it would be increasing buybacks of notes and bonds with 10 and 30-year maturities from 2 billion to 4 billion. And it stated for liquidity reasons only, right, Ben? Sure, liquidity.
Oh, yeah. Oh, yeah. Now, one might say, who cares? What's another 2 billion going to do? It's the equivalent of putting like a few sandbags out once the flood has already started. Well, it's not so much the number, but more about what that implies or signals, as the news suggested that the Trump administration is actively watching the long end of the curve and clearly uncomfortable with 30-year Treasury rates near multi-decade highs. And that news Wednesday was well received by the stock and bond markets, but it was short-lived as it completely reversed the next day on Thursday. Here's what we mean. At the market open on Wednesday, the 10-year Treasury yield was around 4.68%. The yield then fell to a low of 4.63 when Scott Bessent pledged to provide liquidity support. But then exactly 24 hours later, the 10-year yield jumped to 4.71%, which is higher than it was even before the announcement. Say what?
It's wild, man. Wild swings back and forth all in one day. I mean, all right. But here's the good news for investors. It shows the government probably felt it was time to draw a line in the sand, and most likely will be doing more and potentially much more in an effort to control and bring yields down. So, for example, Bessent appeared on CNBC Thursday, promising the White House would soon take a look at spending and insisting the budget deficits would shrink. And he also indicated a potential additional moves. And he said, we have a big toolkit, so we'll see. Ben, it's like when we had all those different operations, it was Operation Twist, and now it's Operation Twist and Shout. I mean, just, okay, let's do something else.
No doubt. There might be some things we don't even know about yet that could be invented just for this. So, by the way, that news was very positive for gold as it lowered the dollar, which caused gold to surge through the recently stubborn $4,500 an ounce resistant level that it was at to end near $4,550 an ounce, which is actually a new summer high. So gold might be a huge beneficiary of all of this. Here are some other positive signs that we're seeing right now. First of all, contrary to what people think, inflation is actually still declining. Both CPI and PPI met or beat expectations, and it furthered the idea that inflation pressures may have peaked back in May. And as a result, September rate hike expectations fell to just 33%, and the market is now expecting only just one rate hike for 2026. And then also, while the 30-year Treasury yield currently is at 5.33%, which is the highest since 2007, it was actually already at 5.2% on May 19th of this year. So it's not that much higher than it was a few months ago.
Yeah, and remember, we've been talking about this, and many experts out there are saying we expect oil prices over the next few weeks and months to stabilize and come down further. And obviously that would be a big help. And then corporate earnings have continued to be exceptionally strong. So in fact, currently on pace for the biggest earnings beats ever. And that's driven partly by AI. And we're not expecting that to drop anytime soon in the next upcoming quarters. So bottom line, growth has been strong enough so far to, the rising inflation and interest rates really haven't mattered that much. The problem occurs if the yields just don't come back down, and then if growth falters. That's when we have a serious problem. That's where you start thinking bear markets and issues like that. So the sooner yields drop, the better overall it'll be.
No doubt. So a question for our listening audience. Is your advisor talking to you about this? Do they ever bring up analysis like we do for you? Do they have a backup plan in case the market does take a turn for the worst? While you don't have to settle for that, your money is obviously too important. So if you want to work with some knowledgeable advisors who have a dynamic investment strategy that looks to capitalize on changing trends, well, guess what? We offer one. And of course, we're referring to our actively managed tactical investment strategy. We call it Advance and Protect, which is the way we manage our client portfolios. And we utilize sophisticated research using quantitative and technical analysis to measure the dynamics of the market under the hood. And when the risk in the market is low, we are fully invested and we intelligently diversify into areas where we see opportunity and strength.
Yeah, believe me, we watch this every day so we can react if it's necessary. If the conditions in the market get worse, we'll actually sell out of the market, go heavier into bonds or cash. And if it gets bad enough, we will literally get 100% out of the market at times when conditions warrant it. So we don't believe in riding market crashes all the way down to the bottom. So you need someone watching your money that closely. And if our investment philosophy resonates with you, reach out. We'd love to connect and chat and do a complimentary consultation. Our phone number is 847-780-2980 or go to our website at bnwealth.com. All right, when we come back, we're going to talk about net unrealized appreciation. Don't go away. Welcome back. Thank you for tuning in. This is Money Hour Radio. It's a show where we try and help you grow your money, pay less taxes, and of course, have a beautiful retirement. I'm one of your hosts, Matt Nadeau. Have with me my esteemed co-host, Ben Barzideh.
Hello, everyone.
And we're both founding partners and wealth managers at Barzideh and Nadeau Wealth Management. We're a local, independent, and comprehensive financial planning firm, and we're located here in Barrington, serving the greater Chicagoland area.
Before we start, we encourage you to like and subscribe to our YouTube channel, moneyhourradio.com. That way you won't miss an episode as soon as it comes out. And then we also encourage you to sign up for our weekly market commentary. It's called the 5-Minute Market Brief. It's succinct, informative, gives you a really good idea of what we're seeing and analyzing in the market that week. You can get that at bnwealth.com. All right, Matt, let's get into our financial planning topic.
Yeah. And this is something that a lot of people may not be familiar with or heard of, and it's something called net unrealized appreciation, or NUA, if you're an acronym junkie, or you just like to say things easier than net unrealized appreciation. So, some people, it's like, hey, that sounds like a new cryptocurrency or government institution. No, it's not. It's actually a pretty amazing and little known tax break. It's in the IRS. That they give us for money we have in our 401ks or our other qualified retirement plans. And it's specifically when you're invested in your own company's stock. So let me give you an example. Let's say you work for Coca-Cola and you buy their stock inside your company plan. It can be especially valuable for people who've done that maybe over many years or a long time and have highly appreciated positions in that company's stock. So when you retire or you leave the company, instead of rolling everything out of your 401k into an IRA, and eventually you're going to have to pay ordinary income tax on all your withdrawals, an eligible individual may be able to actually distribute this employer stock directly from your retirement plan and receive some special tax treatment on the stock's appreciation. It's called NUA. So NUA generally allows that appreciation to get a lower capital gains tax treatment when the stock is sold instead of the higher ordinary income tax rates. So bottom line, you just can end up paying less tax on all those gains.
So let's look at an example. Let's say your employer's stock in your 401k, you paid and your employer paid, say together you put $100,000 into that stock, which is the cost basis. And let's say over the years that stock grows and becomes worth $500,000. So congratulations, you have $400,000 of appreciation on that stock. And that's where the NUA, net unrealized appreciation tax break, can come in. It's like saying, hey, hold on, IRS. Let's not put all of the 500 grand in the same bucket here. And normally, if you roll out that entire 500,000 and put it into a traditional IRA, you've essentially put all of that money into what we call the ordinary income tax bucket. And when you eventually take distributions, those withdrawals are generally taxed at ordinary income. However, here's where things get interesting with the NUA. Instead, that $100,000 cost basis that is generally in the NUA, that will be generally taxed at ordinary income when the stock is distributed. And the 400,000 of the net unrealized appreciation, it's not taxed until the stock is sold later, and at that time it would receive the more favorable long-term capital gains treatment on that portion.
And it's important because this distinction can end up producing enormous tax savings because the ordinary income tax rates, they can be substantially higher than the long-term capital gains tax rates. And it can also prevent a large amount of appreciation from being converted into ordinary income later. So for instance, you can be making $550,000 a year and still be in the 15% long-term capital gain tax bracket, whereas the same $550,000 a year actually puts you in the 35% ordinary income bracket. That's a huge difference. So, for example, let's just use a retiree. They have $1 million of employer stock in a 401k. The cost basis of only $200,000. So if the retiree qualifies for this NUA and distributes the stock, now that first $200,000, that's the basis, that is subject to your ordinary income tax bracket. But $800,000 of it, that NUA, is going to get that special capital gains tax treatment. Not immediately. You pay that when you sell the stock. And that can have tremendous tax savings to the tune of tens of thousands of dollars in an example like this.
Sometimes it's even more, hundreds of thousands.
Yeah.
Now, if the alternative were to do what some people incorrectly do, which is to roll the entire $1 million into traditional IRA, the future withdrawals would generally be taxed at ordinary income, resulting in much higher taxes, especially if the tax rates for you are much higher later in the retirement years, which they likely are for many due to RMDs, and then also the widow's penalty. If one spouse passes, the surviving spouse inherits all of that money and gets put into a higher tax bracket. So the rollover is therefore one of the most important considerations. A rollover is normally an excellent way to defer retirement taxes. It's almost always what's recommended. But in this case, rolling the employer stock into an IRA can eliminate this special net unrealized appreciation treatment for that stock and cost you a lot more taxes later.
Yeah, these aren't easy to analyze and they're not easy to do right. You really got to be careful because there's some pitfalls here. So before you run to your 401k and you're like, that's it, NUA, this is the greatest thing ever, just hold on. There's some considerations. It's really important. So first, this NUA isn't free money. You generally are going to have to pay some ordinary income tax right away when you do that initial stock's cost basis, when you do this first distribution. And second, there are some specific IRS requirements that you got to satisfy in order to qualify for this special treatment. So the transaction actually has to be structured correctly or you can blow it.
No doubt. And then third, there's also the question of whether the NUA is actually better for you than simply rolling everything into an IRA. Sometimes it's not better. So it just depends on the tax rate you're in. It also depends on the amount of appreciation you have, your tax bracket, your state taxes, your expected future tax rates, your investment goals, and how quickly you plan to sell the stock. All of those are important and have to go into the plan. So here's the takeaway. Bottom line is that this NUA can be an incredibly powerful tool, but it isn't a magic trick. For someone with highly appreciated employer stock, the difference between ordinary income tax and these long-term capital gains tax rates that we talked about could potentially mean tens or even hundreds of thousands of dollars in tax savings.
Yeah, I want to bring this back to what the most important thing to realize from our discussion today is you need to know that there might be an opportunity for this before you do a rollover. Don't blindly be going into a rollover because once you roll that over, that employer stock goes into an IRA, you've ruined it. You've just sent your NUA opportunity to the same place all those old passwords were in the trash, it's definitely recommended that you consult with a professional before doing this. So out there in Radio Land, what you want to just know is, do I have some company stock in my 401k or my retirement plan? If you do, don't do anything till you talk to a professional. And Ben knows this, and a lot of people who work with us know this, but we are rollover specialists. We've done hundreds or thousands of these actually over our time in the industry. We walk people through this. We hold their hand to make sure when you're doing a rollover that it is first in your best interest, and second, that all the potential tax benefits are identified and taken advantage of. The last thing you want to do is have such a gigantic sum of money be completely disrupted and ruined because of a small mistake you make when you're not a specialist doing this.
No doubt. And there's other types of company stock that we work with. There's stock options. Those can be confusing at times for people. There's employee stock incentive plans, and there's all these different things. And for someone that's getting ready to retire, and we know this because we talk with people like you all the time, the main concern we hear is, all right, how do I get income? How do I turn what I have into a paycheck? Because my paychecks are going to stop. And then also, do I have enough income to certainly last me the rest of my life? Well, like you said, Matt, we are specialists in that area. We like to work with people and show a plan where we can get you the income you need, and not just income, but rising income to keep up with all of this inflation and expected higher costs in the future. So as with any financial planning, investing, tax, or estate planning strategy, it's essential to work with qualified professionals who understand the concepts and can tailor them to your situation. And it's usually a good financial planner like us. We're kind of like the quarterback of your plan. We help coordinate it with your other professionals, like your attorneys and your CPAs. And if you are in need of a knowledgeable financial planner, someone who puts your interests first, we would be honored if you give us an opportunity to talk with you. If our investment and financial planning philosophy resonates with you, then reach out to us and schedule a complimentary consultation. We will go over your current financial plan. We'll go over your goals. We can also what we call a financial checkup, where we analyze your insurance, your taxes, your estate plan, and your investments, all in one place. If things look good, well, guess what? You'll gain some peace of mind. And if there are holes, then you know at least what areas you want to fix. And many people that we speak with have said that they've never really had someone that they've sat down with that looked at all of their areas of their financial plan all at once. And we can help do that. Remember, it's not just your investments. There's taxes. There's a variety of different things that come into the play. So we can help unpack that for you. So to explore becoming a client, reach out to us at bnwealth.com or call our office at 847-780-2980. All right, everyone, we're almost out of time. God bless you guys, and we will see you next week.
Goodbye, everyone. Have a good weekend.